As Lyft shares continue to trade below their IPO price, the biggest losers from the deal are the company's most loyal drivers. Deirdre Bosa is in San Francisco with a story. Deirdre.
Good morning, Morgan. Well, some Lyft drivers were offered the chance to buy shares, but at a price of $72 after the bankers priced the company far above its last private round. So now, as shares are trading around $70 a piece, and there's a sense on Wall Street that the IPO was overpriced, it is the drivers that are losing money. Jay Crater is one of them.
If I had just taken the cash bonus and held on to it, I'd have $1,000. By buying the stock, I have probably right at this point somewhere around $900 worth of stock. So yeah, so at this point it looks like it was a bit of a mistake to buy the stock. So we'll see though. The stock market is very fickle.
Another driver who bought shares, Nick, though, he told us that he had no regrets and he understands the up and down game of markets. Now, much was made about the opportunity for drivers to buy shares in the IPO. It was a way for them to share in at least a little bit of the wealth created by these platforms as independent contractors versus, full employees. It is still early days, though. We're seeing shares rebound a little bit today, but continued weakness could undo all that goodwill that Lyft was trying to create with this program, and it could further inflame tensions among the driver community, which is so critical to the ride-sharing business model. Could also have implications for Uber, which is also planning to let its drivers buy shares in its upcoming IPO. We asked Jay, that driver who bought Lyft shares you heard from, whether he would buy into Uber if given the option. And despite the weakness in Lyft, he said yes, because he says he's far more bullish on Uber and he thinks it'll win the ride-sharing battle. So straight from a driver.